We are on to the last quarter of the financial year. Taxes need to be saved by March 31. Where should you save and where you should not get into is the topic that we will be discussing in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Dhiren, welcome to the show.
Thank you.
What are the rules or what are the strategy that one should adopt while investing to save taxes?
Just see that, how much can you, one is that tax save is money earned. So, and you should calculate. ATC is a very simple provision. 1.5 lakh rupees investment or some eligible expenditure qualifies there. All you have to do is from that, and we have a lot of mandatory deduction.
And this comes from EPF.
If you are an employee in a organized sector, then your provident fund deduction is also an eligible investment. So from 1.5 lakh rupee, whatever is your provident fund deduction, deduct that. That remaining money is eligible if you can save that much. The difference between the provident fund contribution and 1 lakh rupee is what will get you additional tax break. Okay. Then additionally, there is a section 80CCD where investment up to 50,000 rupees in NPS also it reduces your taxes because it reduces your taxable income up to 50,000 rupees. So if you can do, first do this calculation and then you are all set to, then see you have the resources to invest and save taxes.
What about insurance, life insurance?
Life insurance, I would say that, a lot of people have this long-term commitment. It is also an eligible investment, but it may not be a very wise investment. So reconsider that. One should not be making that buying term life insurance or investment-linked life insurance primarily to save taxes, because you save on taxes, but you lose on the return.
So you're talking about EPF, you're talking about adequate insurance?
Yeah, insurance, term insurance, that one should look at it as an expense.
And exhaust whatever is left in ELSS?
ELSS is the finest alternative because you broadly have two kind of investment avenues. One is that you invest in ELSS, that's the only equity alternative, and the other is, a wide range of things, senior citizen savings scheme, public provident fund, 5-year bank deposit. Okay. They get you guaranteed return, but they get you guaranteed return which is fixed. ELSS holds the promise of higher return. And my suggestion is that, if you are getting, and all these tax saving investments, they come with a lock-in period. So when you are getting locked in, might as well generate higher return.
Okay, so therefore what you're saying is PPF instead of PPS?
Yeah, I have always.
You prefer getting into?
I would say that because most people do a recurring deposit in PPF for 15 years, and it also gets them the tax break. The income from PPF is absolutely safe, is guaranteed, but the return is something which is not adequate. When you are investing with a 15-year time frame, regular investment, I think ELSS will turn out to be a far more rewarding option if you are that disciplined with your investment.
So what about NPS?
NPS is an additional thing. I think one should not consider NPS as a primary tax saving alternative, ATC, because if you do 2 lakh rupees investment in NPS, that also will get you the ATC plus ATCCD1. But I would say that once you have exhausted your ATC avenues, which is, employee provident fund, ELSS, or your term insurance premium, or if you have children's tuition fee going, then after that you should after exhausting your ATC, if you are still left with resources to invest which can save you taxes, then by all means invest that 50,000 rupees in NPS. So that will take the eligibility, the deductible investments from your income to up to 2 lakh rupees. Okay.
And besides PPF, are there any fixed income options to save taxes?
Oh, quite a few. The 5-year tax saving bank deposits, the Sukanya Samriddhi Yojana, senior citizen savings scheme. So you have all these alternatives.
We also have national savings certificates. Okay, fine. What if someone does not have enough money to invest in all that you have mentioned? Are there any other ways in which they can claim deductions?
Yes, the tuition fee going for your 2 young children, that is a eligible deduction. So that is one. Besides that, I think a trick which everybody should aspire for, if you are very limited on resources but saving taxes is important, somehow you should work towards saving and investing for at least 3 years in ELSS. And after that, because the lock-in in ELSS fund is just about 3 years, is 3 years only. So you can start recycling it. Your first investment will be free from the lock-in after 3 years. So you can take that money out and invest again. So you will start getting the you can start, recycling your ELSS investment if you are short on resources.
Okay, Dhiren, besides this, what are the other ways of saving taxes?
One is that, take your deduction for house rent. If you don't get a HRA, then up to 60,000 for self-employed, and so exhaust that provision. Besides that, if you have taken a loan for home, the interest repayment is up to 2 lakh rupees is eligible as a deduction. So and principal repayment of your home loan up to under section 80C is also a deductible expense. So interest paid on education loan, that also qualifies. So exhaust all these avenues while computing your taxes.
Okay. Besides all this, would you like to caution the investors on any common mistakes that they should not make while investing to save taxes?
I think the starting point should not be to save taxes, because and don't wait for the last minute rush, because at that point what happens is that normally you choose a not so great investment and you get the tax break, but you don't generate enough return, or it's a huge compromise on an opportunity. You should use this avenue in terms of maximizing your return, because you are locking your money for a long period of time. So the one most common mistake which every investor does is buys a insurance linked investment, whether it be an endowment plan or a ULIP, and that is something which every investor should avoid.
Okay. So now Dhirendra has communicated very clearly to you how you should save taxes, and don't wait for March to happen. Do it now. We move on now to the Q&A part of our program, and the first question has come from Srinivas Devate, and he says, what are the avenues to save tax for a senior citizen?
Oh, you have all the avenues which we talked about.
Okay.
So, but I would say that, even senior citizens, if they are unable to traditionally senior citizens avoid equity, they think it is risky because it's volatile. So they should consider, ELSS as well. And if you are short on resources, think in terms of recycling every 3 years.
Okay. Pulkit Soni says, how relevant is NPS as a retirement tool for a 35-year-old? Also considering the fact that the different ELSS funds have different investment strategies, how many tax-saving funds should we hold?
NPS is quite useful. If you have enough resources, if you have enough savings, then, and if you have exhausted your 80C, additional 50,000 rupees investment in NPS gets you additional tax break, and that I think is very useful. Now NPS has also improved in terms of its tax treatment and the asset allocation. You can now go up to 75% into equity. So I think in NPS, if you have the more savings and if you can invest, by all means do it.
For a 35-year-old?
Even for a 35-year-old, because I'm talking of additional.
Okay.
Because it gets you the tax break, immediately. Okay. Depending on the tax bracket you fall in, it will save you taxes on additional 50,000 rupee gets deducted from your income for computing taxes on account of NPS. So that I think is, if you can exhaust, if you can avail that, do it. Okay. Which tax saving fund? Don't bother about it. Just choose a good tax saving fund. Of the 4 or 5 of them, which have full market cycle experience, they have been able to, because if you're doing it for 5, 7 years, 10 years, 15 years, you'll find that long-term, the difference in return over such time period is not that much, and it is very hard to guess which one will be the best performing one for your investment time frame. So don't bother. I would say that most, there are some conservative tax saving funds as well, it's not worthwhile because you are getting locked into these funds for 3 years anyway on a rolling basis. So choose a good fund, be at it, don't clutter your portfolio.
Okay, is it advisable to continue with your SIPs when the market is in a bull run? Why? T. Narayanan asks you.
It is advisable to continue your SIP even when the market is in bull run, because you don't know how long, the bull run will start running higher. So continue investing. What will look like a high for the market
Generally,
to you now.
People are worried when it's bearish.
Yeah, but because think of a situation like 2003 to 2007, when market went up from 2,800 to 3,000 to 4,000 to 5,000 to 6,000. So by that time it was established that it's a bull run. But then it went up relentlessly to 20,000. So if you run away, you miss on that opportunity. So one should continue investing. I think you don't have a control on the bull run and the bear phase, but you have an absolute control on how do you conduct yourself and your own time frame, when do you need your money back. So trust yourself more and be disciplined about it. Maybe what you're scared of, that the bull run has taken the values up, and if the market crashes, your investment will go down in value. The way to deal with it is to work on your rebalancing, work on your asset allocation, whether you decide to have 75% into equity, 25% into debt, or 50% equity, 50% debt. Rebalance it annually, so you'll be able to book profits in a bull run. A part of it, you'll be able to invest more in equity when it is in a bear phase, and being disciplined about it, not doing it too often, because it will also, and when you are doing this, be conscious of the exit load and the tax implication.
The next question is from Bindu, and she says, I'm getting a lump sum amount of 1 crore as a divorce settlement. I was considering to invest it in a mixture of fixed deposits and a dividend plan of a balanced advantage fund. But in one of our programs, Dhiren, she heard you recommending then avoid investing in a dividend option. If that is so, then where should I invest now? You have to advise her.
I would say that this 1 crore rupee is very important to support you with income, and the way to deal with it is have your emergency fund in the deposit. Rest of the money you invest in a balanced fund, or if you have never invested in, and it will be a stable take on growth, and create a systematic withdrawal plan. It's like a standing instruction that you want this much money every month credited to your account. The advantage of this as compared to a dividend plan of a balanced fund is that balanced dividends are now taxable. They are subject to 10% dividend distribution tax. So your money, 10% goes by way of taxes. A systematic withdrawal plan will have lower tax implication. So in fact, it will be beneficial if you work on something like 6 to 8% withdrawal plan, 6 to 8% annual withdrawal, no more, and that will be able to support you with regular income, exactly in the form of a dividend, in a more predictable way, with a time and quantum of your choice. Besides that, I think a conservative withdrawal plan, 6 to 8%, will also ensure that every year you can decide it. If your capital value has gone up, then 6 to 8% of the increased capital value, so effectively it will translate into inflation adjusted withdrawal plan, income support for you with this capital.
So you're recommending a balanced
fund, and instead of choosing a dividend plan, choose the growth plan, and give a instruction of regular withdrawal from your investments every month.
Should she invest in a lump sum? Because I've heard you say that
yes,
should not get into
it's very important not to invest the whole money at one go, and it's a very important money. Eliminating the risk of catching a market high is very important. So maybe this money is so important that maybe ideally you should be investing this money. If 1 crore is to be invested in a balanced fund and this kind of money, then it should be spread in a time frame of 1.5 to 3 years, because if you catch a market high, it will be a huge dent on your capital.
Shankar Veli has written in saying that my PPF account matured in 2017, but I have not withdrawn the money as yet. I will need this money in 2021 or 2022. Should I let the money remain in PPF till then, or should I withdraw it and put it in liquid fund?
No, his money is ready for withdrawal, and a lot of time has already gone by, just 2 years left. PPF is getting you good return, and it can be withdrawn anytime. Even the return from PPF which you are getting is tax free. So don't put your money in liquid fund. Let it be there. Take it out only when you need it.
Okay. But would he be still getting interest, I believe, after 17 if he's...
Yeah, you can, you get for next 5 years after the maturity, you get returns.
Okay. Our next question is from Rajwant Bir Kohli, who says that what portion of a portfolio is allocated to equity in case of equity income funds? Are they suitable for a horizon of 3 to 4 years?
Yes, they are conservative vehicle. Normally, 30-35% of the money is invested in in equity, rest in fixed income. And for an investment time frame of 3-4 years for conservative investor, it's an ideal vehicle.
Okay. And Rajesh has written in saying, what kind of debt funds should I invest in for a horizon of 3 years?
I would say that, debt funds have, given us a very unusual experience in 2019, which everybody should keep to heart, that they are subject to risk, and that risk, but that risk never materialized. In 2019 it did. So err on the side of caution. You should not invest in anything beyond, short-term bond funds.
Okay.
Don't get venturesome with your debt fund investment. Trying to optimize your return by 1 or 2% and putting your capital at stake is not a wise thing.
Okay. With this, we come towards the end of the program. In nutshell, Dhirendra, just in few points, if you can impress upon the people what they should do to save taxes, which you have elucidated, that you've not.
I'll just summarize it.
Yeah,
I'll summarize that, avail ATC to the hilt to the extent possible, and computing it is pretty straightforward. We are normally scared of, we think that it is something complex. It is not. ATC is 1.5 lakh rupees eligibility. If you can invest, it is deducted from your income. Your provident fund contribution also is counted as an eligible investment. So 1.5 lakh rupees minus your provident fund contribution, that is the amount of money which you can invest, and that will be deducted from your income, and you will save taxes on that. The best investment avenue for tax saving is ELSS, because it comes with the shortest lock-in period and has the potentially highest possible return for you. The biggest mistake which most people do is invest their money in an endowment plan or a ULIP, which is avoidable. And it also becomes a long-term commitment. Once you do it, you can't undo it, and you get stuck for a long period of time. So tax save is money earned, so avail it wisely.
And don't wait for March to happen. Do your investments now to save taxes. With that,
I'm just reminded of one more thing which I would like to add to this.
Sure.
Assuming that for many investors it gets very hard to save, and somehow if you are barely able to save 1.5 lakh rupees a year, and if you keep doing it for 15-20 years and do nothing else, I think ELSS and looking with a 15-20-25 year time frame, it can become one of the best performing retirement plan for you. If you don't touch this money, keep investing. Equity investing being done with a 3-year lock-in period will also it will also enforce a degree of discipline. So if you're barely investing 1.5 lakh rupees every year, and it also gets you a tax break, there can't be a better investment option, and it can become a very sizable accumulation vehicle for you.
With that optimistic point of view, it's time for us to wind up now. Till we meet next time, it's goodbye from Dhirendra and me, Rajesh Lake. Bye for now.